Annuities are some of the most expensive of all financial products, period. And what Mr. Advisor isn't telling you is that there's more than one way to bill the hell out of you, besides with fees. And if there aren't upfront or ongoing fees, then you're going to indirectly pay dearly through things like lower performance caps, lower participation rates, lower payment calculations. They can reduce the death benefit value. They can add rider fees that reduce the death benefit faster. And oh, by the way, once you start taking income payments, the growth of your income base typically stops dead in its tracks. When most people hear the word return, they think of the return of the Dow Industrial Average or the return of a CD. So when people hear about an index annuity that has a 6, 7, or 8% guaranteed return with an upfront bonus, it sounds too good to be true. Well, the problem is that they're merely talking about the growth of just an accounting ledger, a fictitious bucket of money that is later used as the basis for determining your income payment rate. That accounting ledger is not cash surrender value. There is no annuity on the planet that lets your money grow at 6, 7, or 8% per year for X amount of years, and then you can just cash out and be on your merry way. If annuity salesmen were being honest instead of lying their asses off, they would talk in terms of annualized return on investment or internal rate of return on an annualized basis. And so in reality, with index annuities, you can expect an internal rate of return that's going to be merely on par with CDs. So when you call out Mr. Advisor for lying to you about the return word, his rebuttal will be, oh, but it's not about return on your money, it's about return of your money. It's not about annualized return on investment, it's not about the end result, it's about the ongoing result. It's about getting higher income. And annuities are designed to give you more income initially, as compared to if you were to adhere to the 4% spending rule with traditional investing. But as time goes on, annuities are designed to give you comparatively less income as you get older. One phrase you see on your screen perfectly sums up how index annuities work. Insurance salesmen are great at turning a negative into a positive. Once you start taking income payments from an index annuity, typically, number one, the growth of your money stops, and number two, whatever payments are made to you are subtracted from your beneficiary's inheritance. And so typically, once you reach your actuarial life expectancy or sooner, there is no money left. When you raise concern with Mr. Insurance Salesman about the various shortfalls of index annuities, for example, if you say, I don't like the fact that index annuities stop growing once I start taking income payments, he'll say, that's not true. I have this other index annuity that grows with the rate of inflation up to a certain cap. But what he isn't telling you is that with so many moving parts to index annuities, if they're going to give you one thing, they're going to taketh away somewhere else. It's like that game Whack-A-Mole. You can never win. So when Mr. Advisor claims that you just have to find the good annuities, insinuating that some insurance companies are playing Santa Claus, he's full of crap. Many, if not most, investors are utterly and completely ignorant about how you mitigate stock market risk by investing in bonds too. Bonds are slow, boring, and relatively consistent, and they tend to move in the opposite direction of stocks. So when stocks crash, your portfolio doesn't take a nosedive like it would otherwise if you were 100% invested in stocks. And Mr. Advisor, who is trying to sell you that high commission annuity, is not going to educate you on modern portfolio theory, nor show you any of these charts, because education about bond stock diversification is bad for business. Insurance salesmen are famous for dreaming up their own self-serving rules of thumb, such as declaring that a certain portion of your portfolio needs to be guaranteed. Then they'll say stocks and bonds are not guaranteed, and this is supposed to automatically disqualify traditional investing. But what he isn't telling you is that we have 90 years of return data, which gives us trend lines from which we can make reasonable forecasts. And what he isn't telling you is that risk is an inherent part of higher reward. If you want to earn CD-like internal rates of return, which is what annuities provide, have fun. Lock your money up in an annuity. But when you look at just how risky a low-risk mix of bonds and stocks is, you realize that you don't need any guarantee. Oh, and by the way, annuity guarantees are not guaranteed in the first place. What they really should be talking about is liquidity risk, the risk that for any number of hundreds of reasons you might need to get your money back, but can't because it's gone for good in that annuity that you started taking income payments on. In contrast with bond and stock index funds, you can sell 100% of it immediately and without penalty. Just remember, no insurance salesman can predict whether or not you might need to get your money back. Why do they give you this factoid? The statement suggests that if you dump money into an index annuity, this problem is somehow solved. But in reality, if you don't have enough money to retire on, you don't have enough money to retire on. An annuity doesn't change that. It makes matters worse as you get older, and it eventually leaves your beneficiaries with nothing. Annuity salesmen love using the fiduciary shield to gain your trust. I'm a fiduciary, therefore you can trust me. Bullcrap. Fiduciary duty alone will not protect you from being sold annuities in the first place. Now, this is not to say that you want to work with a non-fiduciary either. They're even worse. You instead need to find yourself a fee-only fiduciary who will work on a one-time, one-task, or hourly basis to come up with a financial game plan, and that's if you need money help. Because the actual investing part is easy. Annuity salesmen are world famous for falsely suggesting that they somehow have no conflicts of interest. I hear a lot of these guys on the radio paying for expensive airtime and at the same time telling listeners that they're just trying to help out. They're not trying to sell you anything. Yet they want to meet with you to go over your finances. Amazing. They're like the reincarnation of Mother Teresa, paying for airtime and volunteering their time for charity. I hear one guy say, "We don't sell products, we find solutions." Yet I looked him up. Sure enough, he's a licensed insurance salesman. And I searched for him on napfa.org, which lists fee-only advisors who don't earn commissions off of selling products. And sure enough, he's nowhere to be found on this site. So the bottom line, whenever, I mean anytime you hear someone saying happy things about annuities, in particular index annuities or variable annuities, I guarantee you that you are dealing with a licensed insurance salesman with a life-only license so that he can sell index annuities, or maybe a variable contracts license so he can sell variable annuities. Either that, or he's someone who stands to earn a backdoor commission somewhere, somehow, someplace by passing you along to someone else who's going to process the lucrative annuity transaction.